All right, what if I told you that everything you think you know about venture capital is kind of wrong? You know, the idea that the biggest, baddest funds with billions of dollars are the ones to beat. Well, it turns out they're actually losing, and they're losing to the little guys. Today, we're going to pull back the curtain on one of the biggest secrets in investing. Why in VC, it turns out smaller is almost always better. Yeah, and the analysis we're digging into today kicks off with this really provocative line. It basically says, the venture capital industry has a dirty secret that nobody wants to talk about. Ooh, intriguing, right? It makes you wonder, what are the big players trying to hide? So let's get into it. What is this secret? Okay, so to really get what this secret is all about, we first have to talk about the image of VC that we all have in our heads. You know, the one that's been built up for years and years. When you think of venture capital, what pops into your head? For most of us, it's those legendary firms on Sand Hill Road, right? These massive billion-dollar funds. Their names are always in the headlines, and they're always chasing the next huge unicorn company. I mean, that's the picture we've all been sold. That's what success is supposed to look like. But hold on a second. This is where we need to stop and ask the really important question, the one that gets right to the heart of this whole secret. Is that really where the best returns are coming from? I mean, if you actually follow the money, are these giants the ones delivering? Or is the real action happening somewhere totally different? All right, now let's get to the good stuff, the actual evidence. Because once you start digging into the data and look past all those flashy headlines, that whole popular story, it just completely falls apart. So here it is, the secret, laid bare by the numbers. The bigger the fund, the worse the returns. It's a straight-up inverse relationship. The mind-blowing, spectacular returns, they're not coming from the giants. They're coming from these smaller funds that, honestly, you've probably never even heard of. And this isn't just a fluke, not by a long shot. I mean, just look at this chart. Check out these numbers. Every single year since 2015, the funds under $100 million have just crushed the mega funds. This isn't a one-time thing. It's a super consistent, totally undeniable pattern. And it gets even more interesting when you dig a little deeper, because it's not just about the total size of the fund. It turns out sector specialists are wiping the floor with the generalists. You've got these hungry first-time fund managers who are outperforming the old guard, the veterans. And those really explosive returns, we're talking 5x, 10x, even 20x your money. Those are coming from these tiny up-and-coming funds. Okay, so the big question is why, right? Why is this happening? What is it about being small that gives these funds such a massive edge? Well, it really boils down to this powerful three-part formula. First, small funds can get in way earlier. They're investing in promising companies at really low valuations long before they're on anyone else's radar. Second, they are hyper-specialized. They know their niche inside and out, which gives them this almost unfair advantage in spotting opportunities nobody else sees. And third, because they have fewer companies in their portfolio, their partners can be way more hands-on. They're all in, really helping founders succeed. So this isn't just some clever little strategy. No, this is a sign of a massive shift in the entire venture capital industry. We are literally watching a brand new playbook for success being written right now, in real time. Let's break it down like this. Think of the old way of doing VC. It was all a game of access, right? It was all about who you knew. Your exclusive network got you into the so-called hot deals. But the new model, that's a game of expertise. It's about what you know and using your deep, real-world skills to actually help build these companies from the ground up. So this is what modern venture capital actually looks like. It's where these three things come together. Having that laser-focused expertise, keeping fund sizes small and manageable, and building real, deep relationships with founders. That's it. That's the winning formula right now. Okay, so what does all this mean for the future of investing? Well, it means the door is swinging wide open for a totally new kind of investor to step up and lead the way. I mean, if the old guard, these giant generalist funds, are getting beat so consistently, you gotta ask, who is this new investor? Who's the one actually leading the charge now? And the answer is what we call the operator investor. Now, this is not your traditional Wall Street finance person. Nope. This is an expert, a builder, a product manager, a marketer, an engineer, someone who has real, deep, in-the-trenches experience in a specific industry, and they take that knowledge and use it to invest in and actually support the next wave of founders. And that right there brings us to what might be the biggest takeaway from this whole thing. The future doesn't belong to investors who just pretend to be operators. It belongs to the actual operators who decide to become investors. That real, authentic, hands-on experience, that is the most valuable currency in this game now. Which leaves us with this final thought, a kind of call to action. If you are one of those operators, someone with deep expertise in your field, well, this whole shift is your invitation. Stop waiting around for someone to give you permission to get in the game. The time to start building the future is right now.